Alright, in today's video we're diving into a powerful take from Dan Ives, who says there's a $700 billion opportunity the market is completely ignoring, and that Wall Street may be seriously underestimating Oracle, with the potential for the stock to even double. He shared all of this in a recent interview on Bloomberg Television, breaking down the current state of the market and tech stocks. I'm gonna play you that clip first, then I'll give you my full breakdown and reaction to what he said, and finally, I'll walk you through 3 big tech stocks to buy now for the long term. Let's hear what Dan Ives has to say.
Well, we want to talk tech. We talked to Dan Ives, Global Head of Technology Research at Wedbush Securities. Dan, I'm guessing the conversations you're having with your clients over the last several weeks are a lot different than what they were kind of late last year as it relates to tech. How do you frame it out for us?
Look, Paul, I think right now it's really about, okay, CapEx, but where's the monetization? Are you starting to see it? Is it starting to actually spread out beyond just big tech? And I think you're starting to see that obviously with Intel, Cisco, and others. Look, and obviously it's been a huge debate, right? Relative to the Anthropic software ghost trade. We saw what happened this week in terms of ServiceNow and others. So I think I would call it a huge debate. And that's why it all leads to next week really being like huge pieces to the puzzle of the tech trade.
And speaking of next week, a ton of earnings coming out. Wednesday is going to be the high water mark. You've got Microsoft, Meta, Alphabet, Qualcomm, Amazon, all reporting after the close. In total, 13 companies within the NASDAQ 100 reporting on Wednesday. So Dan is going to be very busy on that day. But Dan, what is the market sentiment like right now when it comes to CapEx? Because for a while, if companies reported ended up saying that CapEx would be more than they had forecast, it was seen as okay, and then it was seen as negative. How are investors feeling right now?
Yeah, it's sort of, that's been a hot and cold situation, right, relative to the CapEx. I think now there's almost a consensus view where it's like, okay, CapEx is going to be reiterated by big tech. No big tech company is going to slow down CapEx going to next week. If they did, stock would be down because that would ultimately be a negative in this arms race. I think the big question is going to be with the hyperscalers, specifically Microsoft, Google, Amazon. Do you see accelerations beats when it comes to cloud growth? That's important in terms of capacity. But look, what it really means is the CapEx is now starting to bear fruit. The monetization's happening. You're seeing it on the software and the hyperscaler side. And look, that's the big piece. That's really the debate. Do you start seeing monetization? I think we start to see it next week. And I think Meta is another one we'll see on the advertising side.
Dan, I know you initiated coverage of Oracle. Talk to us about that company, how you see it participating in this tech stack here going forward.
Yeah, and Paul, I covered it for many years, and the reason I like reinitiate on it here is just because I believe the street is way miscalculating this name. I mean, look, I get the worries about the debt and what they're taking on given OpenAI and what they're going for in terms of the $700 billion that they're going after and the $50 billion of debt. I think Oracle is going to be a tremendously bigger company the next 2, 3, 4 years than it is today. I think investors are way discounting their ability to monetize what's going to be this backlog and really, as more and more companies move to the AI revolution with Oracle. And that's our whole call. I mean, 225 is price target, but this stock ultimately that could double as they monetize AI over the coming years. I think way, way oversold.
I mean, the thing with Oracle is that it needs to borrow so much money that it's got to tap the public markets and the private markets kind of everywhere in order to be able to fund this build out. And we've heard from Moody's warning that private credit funds with a lot of exposure to software and tech face a lot of refinancing risks because there's a bunch of debt that matures starting in 2028. How do you think about that in terms of what that means for these big tech companies' needs to borrow?
Yeah, I think, and look, it's a great point. Obviously, huge debate. Like when you get things like Thoma Bravo, Medallion, some other things, you can paint them all with the same brush, right? When you look at Oracle, you're talking about a company that the amount of debt that they'll take on is still pretty small relative to their cash flow generation and the overall, what I believe, structure of the business. I think they'll be able to raise, and they've already sort of laid out the 45 to 50 billion how they're going to do that. Now, look, is it ideal? Because companies obviously free cash flow, you don't want to see software companies take on debt. But Scott, my view is to take on 50 billion of debt to go after 800 billion, that to me is a bet that I want to see them take.
Hey, Dan, let's just switch gears to Tesla. They made some news just yesterday, kind of talking about CapEx, and they're boosting their CapEx to $25 billion for AI and for their robot business. Put that in context for us. How do you think is that a good move for this company?
I think it's exactly what they need to do. I mean, Paul, we've always talked about it a lot. It's like the future is about autonomous robotics. I mean, this is a company that, from a physical AI perspective, I view NVIDIA and Tesla, two best physical AI plays in the market. I want to see them do this step by step, build it, because that's really the next 5-10 years. That's what Tesla's an AI company going forward. This is not an auto company.
Yeah, that's been made very clear. I mean, certainly Elon Musk has been pushing that narrative for a long time now. I'm curious, and this is might be a really basic question, but how does the war in Iran and the uncertainty there affect these big tech companies as they report? I mean, do we expect any kind of mention of the uncertainty, the fog of war, affecting their decision making, their planning in any way?
I mean, like ServiceNow hit it a bit, right, in terms of some of the Middle East deals. Look, I think when you think in terms of a lot of the build outs outside the US, some of the bigger data center, big AI build outs are in UAE, Saudi. But I don't really think that that's something that's going to be a huge thing on the conference call. I think that's much more year and a half from now, 2 years from now. Now, I think the big question is supply, helium, especially through the Strait. We were just in Asia for 2 weeks. I continue to think unless this stalemate lasts past Memorial Day into June, July, like for now, I think it's pretty contained. But look, I think investors want to understand what the demand environment looks like. And these companies, they're not slowing things down in any way
Right.
because of the geopolitical.
So first, you've got to understand the backdrop. The Nasdaq Composite is up, tech is moving, and sentiment has clearly shifted compared to late last year. Back then, the big fear was overspending. Too much capex, too much AI hype, not enough return. Now, that narrative is flipping. What Dan is basically saying is this: the conversation is no longer about whether companies should spend, it's about whether that spending is actually starting to work. And that's a big shift. Because for months, investors were questioning whether all this AI investment from companies like Microsoft, Amazon, and Alphabet would ever translate into real growth. Now the market is starting to look for proof. Not promises, proof. And personally, I think this is where things get interesting. Because markets don't reward spending forever. At some point you need results. And that's exactly what next week's earnings are supposed to show. When Dan talks about that huge week of earnings, he's not exaggerating. You've got basically the entire AI backbone reporting at once. And the key question is simple: is cloud growth accelerating? Because if cloud growth is speeding up, that means all that CapEx is actually doing something. It means the infrastructure is being used. It means demand is real. And if that happens, that's when this whole AI trade goes from hype to something much more sustainable. But here's the flip side. If those numbers disappoint even slightly, I think the market reacts hard, because expectations are no longer low, they're high. Now when he talks about CapEx being hot and cold, that's exactly what we've been seeing. At first investors loved it, then they hated it. Now there's this uneasy acceptance. Basically, the market has come to terms with the idea that this is an arms race. If Microsoft slows down spending but Amazon doesn't, Microsoft loses ground. Same with Alphabet. So now, ironically, not spending is actually worse than overspending, and I completely agree with that take. In a platform shift like AI, you don't win by being conservative, you win by being early and aggressive. Then he shifts into something that I think a lot of people are overlooking right now, and that's Oracle. This is where Dan gets very bullish. He basically says the market is completely mispricing Oracle. And his argument is pretty straightforward. Yes, Oracle is taking on a lot of debt, yes, they're going big, but they're doing it to go after something massive. He's talking about a potential $700 to $800 billion opportunity tied to AI and cloud infrastructure. Now here's where I'll add my own take. I think he might be right about Oracle being underestimated, but the risk is very real. Taking on tens of billions in debt in a rising rate environment is not nothing. That's not a small bet. But at the same time, if they actually pull this off, this could be one of those rare moments where a legacy tech company reinvents itself in a major way, and those opportunities don't come around often. So I understand why he's excited. He's basically saying this is a calculated risk worth taking. Then we move into Tesla. And this part is really important because it shows how the AI narrative is expanding beyond just software. Tesla increasing capex to $25 billion for AI and robotics, that's not a small move. And Dan is very clear about this. He doesn't even see Tesla as a car company anymore. He sees it as a physical AI company, and whether you agree with that or not, that's the bet. Autonomous driving, robotics, AI integrated into the physical world. Personally, I think this is where things get a little more speculative. The vision makes sense, but execution is everything. And Tesla has a history of setting timelines that don't always play out the way investors expect. So while I agree with the direction, I'm a bit more cautious on the timing. Then toward the end, they touch on geopolitics, specifically tensions involving Iran. And honestly, Dan kind of downplays it in the short term. He acknowledges there could be some regional impact, especially in places like the Middle East where data center expansion is happening, but overall he doesn't think it's going to materially affect earnings right now. And I think that's a fair take. Markets tend to care about geopolitics when it directly hits supply chains or demand. Right now the bigger story is still AI demand. That's what investors are focused on, but he does bring up something subtle that I think is worth paying attention to. And that's supply chains and global buildouts over the next 1 to 2 years. Because if geopolitical tensions escalate, that could absolutely impact where and how these companies build infrastructure. So it's not a today problem, but it could become a tomorrow problem. And that's really the theme of this entire interview. We're in a transition phase. The AI trade is moving from expectation to validation, from spending to results, from hype to execution. And the next wave of earnings is going to tell us a lot about whether this narrative holds or starts to crack. And if you ask me, this is one of those moments where the market is about to get a lot more selective. Not every AI stock is going to win, but the ones that actually show real growth tied to all this spending, those are the ones that could separate in a big way. Now we're going to break down 3 big tech stocks you can buy and hold for the long term as the next wave of AI, infrastructure, and data dominance reshapes the global economy. The first company is Broadcom, ticker symbol AVGO. Now most investors think they understand Broadcom. They hear semiconductor company, they think chips, they think cyclical demand, and then they move on. That is a mistake. Because Broadcom is not just a chip company, it is one of the most strategically positioned infrastructure companies in the entire tech ecosystem. And once you understand that, the long-term opportunity starts to look very different. Let me explain. Every major technological shift has one thing in common. There is always a layer of infrastructure that quietly powers everything behind the scenes. In the early days of the internet, it was networking hardware. During the smartphone boom, it was mobile processors. Now, in the age of AI, it is advanced semiconductors and data infrastructure. Broadcom sits right in the middle of that layer, and not in a small way. Broadcom is deeply embedded in the systems that move data, process information, and enable large-scale computing. When companies build out data centers, when AI models train on massive datasets, when cloud infrastructure expands across the globe, Broadcom is part of that process. This is not optional infrastructure. This is essential infrastructure. And that is exactly where you want to be as a long-term investor. Now let's talk about the biggest driver behind Broadcom's growth right now, which is custom AI chips. This is one of the most important trends happening in tech today, and a lot of investors are still underestimating it. Instead of relying only on general-purpose chips, companies are increasingly designing custom silicon tailored specifically for their workloads. And why does that matter? Because AI workloads are extremely demanding. They require massive processing power, efficiency, and speed. Custom chips allow companies to optimize performance in ways that standard chips simply cannot match. Broadcom has positioned itself as a key partner in this shift. It works closely with major customers to design and deliver these custom solutions. And once those solutions are integrated into a company's infrastructure, switching away becomes incredibly difficult. Think about that for a second. If a company builds its entire AI system around custom-designed chips, replacing that setup would require redesigning the system, retraining models, and taking on significant operational risk. That creates what I would call a deep and sticky moat. And in investing, sticky relationships are incredibly valuable because they lead to recurring revenue, long-term contracts, and predictable growth. Now here's where Broadcom separates itself even further. It is not just relying on semiconductors. Over the past several years, the company has been aggressively expanding into infrastructure software. This is a strategic move that completely changes the nature of the business. Software revenue is different. It is more predictable, it carries higher margins, and it creates ongoing relationships with customers. By combining semiconductor solutions with infrastructure software, Broadcom is building a hybrid business model that captures value at multiple layers of the tech stack. That is a powerful position to be in, because it allows the company to participate in both the hardware side of innovation and the software side of recurring value creation. Now let's talk about financial strength, because this is where things become very real. Broadcom has been generating strong and consistent free cash flow, and I want to emphasize this point. Free cash flow is what ultimately drives long-term value. It is what allows a company to invest in growth, make strategic acquisitions, reduce debt, and return capital to shareholders. Broadcom is not just growing revenue, it is converting that revenue into actual cash. That gives it flexibility, and flexibility in a rapidly evolving industry is a huge advantage. According to recent data, Broadcom continues to benefit from strong demand tied to AI infrastructure and networking solutions. Its ability to scale alongside its customers is a key factor in its growth. As companies invest more into AI and cloud computing, Broadcom's products become even more critical, and that creates a compounding effect. More demand leads to more integration. More integration leads to deeper relationships. Deeper relationships lead to more long-term revenue. This is how you build a durable business. Now let's talk about margins and pricing power. Broadcom operates in markets where the barriers to entry are extremely high. Designing advanced semiconductors requires expertise, capital, and time. Building software that integrates into enterprise infrastructure requires trust and proven performance. Not many companies can do both at a high level. That gives Broadcom pricing power. When customers rely on your technology and switching is difficult, you have the ability to maintain strong margins even in competitive environments. And that is exactly what we see here. Now here's my personal take, and I want to be very clear about this. I think Broadcom is one of those companies that a lot of investors overlook because it is not flashy. It is not constantly in the headlines. It is not the company people talk about at dinner parties. But that is often where the opportunity is. Because while everyone is focused on the front-end applications of AI, the real money is often made in the infrastructure layer. The companies that make everything else possible. And Broadcom is one of those companies. It is building the backbone of the AI economy. And as that economy grows, its role becomes more important, not less. Now, of course, we have to talk about risks. No investment is perfect. Broadcom operates in a highly competitive industry where technology evolves quickly. There is always the risk of disruption. There is always the need to stay ahead. But when you look at its current positioning, its diversified business model, and its strong financial foundation, it is clear that this is a company built for long-term relevance. And that is what we are looking for, not short-term hype, long-term durability. Because at the end of the day, the companies that win over decades are the ones that become deeply embedded in the systems the world depends on. And Broadcom is already there. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to the second company, Taiwan Semiconductor Manufacturing Company, ticker symbol TSM. If Broadcom sits at the center of infrastructure design and integration, Taiwan Semiconductor sits even deeper, at the absolute core of modern technology. This is the company that actually builds the chips that power the world, not designs them, builds them. And that distinction is everything, because designing a chip is one thing. Manufacturing it at scale, at the most advanced levels of precision known today, is something entirely different. It requires decades of expertise, massive capital investment, and a level of engineering excellence that very few companies on the planet can achieve. Taiwan Semiconductor has that. And because of that, it has built one of the most powerful competitive advantages you will ever see in the market. Let me break this down in a way that really hits. Imagine the entire tech industry as a pyramid. At the top, you have applications, AI models, software platforms, and all the things people interact with. But underneath all of that, there is a foundation. That foundation is chips. Without chips, nothing runs. No AI, no cloud, no smartphones, no data centers, nothing. Now here's the key point. Not all chips are the same. The most advanced chips, the ones that power cutting-edge AI systems and high-performance computing, require extremely sophisticated manufacturing processes. and Taiwan Semiconductor dominates that space. This company operates at the leading edge of semiconductor fabrication. We're talking about incredibly small process nodes, extreme precision, and manufacturing complexity that is almost impossible to replicate. And this is not something a competitor can just decide to build next year. This is the result of decades of continuous investment, innovation, and execution. That's the moat, and it's one of the strongest moats in the entire global economy. Now let's talk about why this matters right now more than ever. We are entering a period where demand for advanced chips is accelerating at a pace we have not seen before. AI is the main driver behind this. Training large AI models requires enormous computational power. Running those models in real-world applications requires even more. And all of that computing power depends on advanced semiconductors. So as AI adoption grows, demand for these chips grows with it. And guess who is in the best position to supply them? Taiwan Semiconductor. This is not a temporary trend. This is a structural shift. Because once companies integrate AI into their operations, they don't go back. They continue to invest, they continue to scale, and that creates ongoing demand for more powerful and efficient chips. That's where Taiwan Semiconductor benefits. Now let's bring this back to the financial side, because this is where the story becomes even more compelling. Taiwan Semiconductor has continued to deliver strong revenue performance driven by demand for advanced nodes. These advanced nodes, which are used in high-performance computing and AI, carry higher margins and stronger pricing power. That's important, because it means the company is not just growing, it is growing in a way that improves profitability. And when you combine that with its scale, its customer relationships, and its technological leadership, you get a business that is incredibly difficult to compete with. Now here's something I want you to really think about. Taiwan Semiconductor does not compete with its customers. It enables them. That creates a unique dynamic, because instead of being in competition with the biggest tech companies, it becomes a critical partner to them. And when you become a critical partner, you become very hard to replace. That is why this company has been able to build long-term relationships with some of the most advanced technology players in the world, and those relationships tend to deepen over time. Now let's talk about diversification. One of the strengths of Taiwan Semiconductor is that it benefits from multiple growth trends at the same time. AI is a major driver, but it is not the only one. High-performance computing, mobile devices, automotive technology, and connected systems all require semiconductors. And as these industries evolve, they demand more advanced chips. So this is not a one-trend story. This is a multi-decade, multi-industry growth story. And that's exactly what you want in a long-term investment. Now I'm going to give you my personal take here because this is important. I see Taiwan Semiconductor as one of the most foundational companies you can own in a tech-focused portfolio. Because no matter which company wins in AI, no matter which platform dominates, they all need chips. And not just any chips, they need the most advanced chips. And Taiwan Semiconductor is one of the very few companies that can deliver them at scale. That puts it in a position of long-term strength. But we also need to be realistic. There are risks. The biggest one is geopolitical risk. Taiwan Semiconductor operates in a region that is strategically important and sometimes unpredictable, and that is something you cannot ignore. However, there is another side to this. The global economy is heavily dependent on this company, and when a company becomes that important, it creates a different kind of dynamic, because there is a strong global incentive to maintain stability and ensure continued production. Now I'm not saying that eliminates risk, but it does add an interesting layer to the situation. Now stepping back, when you look at Taiwan Semiconductor, you're not just looking at a chip manufacturer, you're looking at a company that sits at the foundation of modern technology, a company that benefits from almost every major trend shaping the future, and a company that has built one of the strongest competitive advantages in the world. That is why it belongs on this list. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's get into the third and final stock, Palantir Technologies, ticker symbol PLTR. If the first two companies we talked about are building the physical backbone of the AI revolution, then Palantir is operating at the intelligence layer. This is where raw data turns into decisions. This is where information becomes action. And in the AI-driven world we're moving into, that layer is becoming just as important as the infrastructure itself. Because having data is one thing. Understanding it, organizing it, and actually using it effectively is something completely different. That's the problem Palantir is solving. Now here's what makes this company unique. Palantir does not just provide tools, it builds deeply integrated platforms that sit inside organizations and help them make sense of complex, often chaotic data environments. We're talking about massive datasets coming from different systems, different formats, and different sources. Most companies struggle to unify that data. Palantir specializes in it. Its platforms allow organizations to bring all that data together, analyze it in real time, and make decisions based on actual insights rather than guesswork. And that becomes extremely powerful when you layer AI on top of it, because AI models are only as good as the data they are trained on. If your data is fragmented, messy, or incomplete, your AI results will reflect that. Palantir helps solve that problem. It creates a structured environment where AI can actually function at a high level. That's why the company is gaining more attention now. The world is finally catching up to what Palantir has been building for years. Now let's talk about the business model, because this is where things get interesting. Palantir has two main segments, government and commercial. On the government side, it has long-standing relationships with defense and intelligence agencies. These contracts tend to be stable and long-term, providing a consistent revenue base. On the commercial side, the company has been expanding aggressively, bringing its platforms to private enterprises across different industries. And this is where the growth opportunity really opens up, because the number of potential commercial customers is massive compared to the government segment. As more companies adopt AI and data-driven decision-making, the demand for platforms like Palantir's is increasing. Now let's talk about growth and financial progress. Palantir has been showing strong momentum in its commercial segment, which is a key indicator of future scalability. At the same time, the company has been improving its profitability. And this is a big deal, because for a long time one of the main criticisms of Palantir was that it was not consistently profitable. But that narrative has been changing. The company has been focusing on efficiency, improving margins, and moving towards sustainable profitability. That shift is important for long-term investors, because it shows that the business is not just innovative, but also financially viable. Now here's something that I think a lot of people overlook. Palantir's strength is not just in its technology, it's in how deeply that technology integrates into its customers' operations. Once a company adopts Palantir's platform and builds workflows around it, switching away becomes difficult. This creates a sticky relationship, similar to what we talked about earlier with infrastructure companies. And sticky relationships lead to recurring revenue. Now let me give you my personal take on Palantir, because this is where things get a bit more nuanced. I think Palantir is one of the most interesting companies in the AI space, but it's also one that requires patience. This is not a company that grows in a straight line. Adoption takes time, sales cycles can be long, and integrating complex systems into large organizations is not a quick process. So if you're looking for instant results, this might not be the stock for you. But if you're thinking long-term, if you believe that data and AI will continue to become more central to how organizations operate, then this is a company worth paying attention to, because its core value proposition becomes stronger as data becomes more important, and we are clearly moving in that direction. Now let's zoom out and connect everything we've talked about in this video. You have Broadcom, which is powering the infrastructure and connectivity layer. You have Taiwan Semiconductor Manufacturing Company, which is manufacturing the advanced chips that make modern computing possible. And then you have Palantir Technologies, which is turning data into actionable intelligence. These are three different layers of the same ecosystem, and that's what makes this combination so powerful from a long-term perspective. You're not just betting on one trend, you're positioning yourself across multiple critical parts of the technology stack. Now I want to ask you something. Out of these three companies, which one do you think has the strongest long-term advantage, and why? Is it the infrastructure dominance of Broadcom, the manufacturing leadership of Taiwan Semiconductor, or the data intelligence capabilities of Palantir? Let me know your thoughts in the comments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.